There are lots of things you could do. Bury it in a tin can in the backyard, for instance. But idle money may in time depreciate. Or you could spend it on a couple of nights out a week with the wife. This seems like a lot of fun. But with this kind of life, you'd depreciate. So why not put your money to work?
Put my money to work?
That's right, Mr. Finchley. You can own a share of American business. There are over 1,200 companies listed on the New York Stock Exchange. Companies which employ more than 11 million people, produce half of all the goods made in America, and pay about half the nation.
Welcome back. This is Ask the Compound. You ask, we answer. On today's show, we will be answering viewer questions about when it's time to fire your financial advisor, how elections and politicians should and shouldn't impact your investment decisions, the right time to sell a home in the home buying transaction process, how to invest a slug of cash sitting on the sidelines during a bull market, and what's the best hedge if China invades Taiwan. A lot of World War III questions lately, which is always lovely. If you have a question, our email here, askthecompoundshow@gmail.com. Today's show is sponsored by Rocket Money. Listen, I love talking about the markets, investing, the economy, but personal finance always comes first. You can't invest if you don't know how to save and manage and budget your money. Rocket Money can help. It's a personal finance app that finds and cancels your unwanted subscriptions, monitors your spending, helps lower your bills so you can grow your savings. I like to have my finances on autopilot. I like to automate as much as possible, but you still have to check in every once in a while, right? Rocket Money is a great way to do that. Just this morning, I did a quick scroll of Rocket Money on my account. Credit card payment here, transfer to my IRA over there, Amazon payment pending over here. We get like six Amazon boxes a day because my wife buys everything from there. Upcoming payments on the side, very useful. Rocket Money has over 5 million users. They saved users a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all the app's features. Stop wasting money on things you don't use. Cancel your unwanted subscriptions by going to rocketmoney.com/ATC. That's rocketmoney.com/ATC.
You know what I like about Rocket Money? I like the notification telling me how many bills I have coming up that week. That's always useful. So I know if I need to like move some money around or something.
Useful and also terrifying, correct?
Yeah, both. Yeah.
All right, we need your help. We love our audience and like to help better understand them. We have a short survey. Duncan, where's the link? Is it on YouTube?
Yeah, it should be in the description. And if it's not right now, it will be shortly.
Hit the link. It'll take, 5 minutes. We'd greatly appreciate it. Maximum compound karma points if you do this. Just a few simple questions. Get to better know our audience. Duncan, did we find a new engineer yet? Are you still hiring?
We've got some really good applicants so far. But yeah, if you're watching this and you're a video editor that also knows their way around a camera and on-set production, send your resume our way. askthecompoundshow@gmail.com.
All right, let's get to questions.
All right.
First one.
Up first today, we have a question from David. I've had a financial advisor for the past 6 years. They really helped me get my financial life in order and instilled good habits that my parents just didn't have the education or experience to give me. However, I don't own a home and don't have a complicated financial life, so I'm questioning the value they provide. I have a great accountant I work with on a fee or project basis. I know enough to rebalance a portfolio and do my own tax loss harvesting. What else should I be considering regarding continuing to work with my advisor as I weigh the performance of my portfolio and the fees?
We've gotten plenty of questions over the years about when's the right time to hire an advisor, especially people approaching retirement. We asked that one. This one is about firing your advisor, and it sounds like this advisor was used as a form of education. I think there's a lot of inertia in decisions like this. It's kind of like changing your bank or your dentist, where sometimes it's just easier to stick with it and not make the change because the financial records and moving of accounts and moving money. So do you need a financial advisor is a legitimate question. I think there's some questions that you should probably ask yourself when thinking through this. So I would like to know, is your current advisor doing exactly what they told you they would do in terms of services and setting expectations? Do you personally find value in the financial planning process or like the regular conversations you have with this person? How often are you communicating with them? Are they communicating with you on a regular basis proactively? Did they create a financial plan for you? Do you review that financial plan on a regular basis? Have they actually helped make your life easier? Have they helped make you a more disciplined investor in following your plan? Do they help with your lesser self in a lot of ways and knowing what the pain points are for you? Are they helping you track and or define your goals? And are you on track to reach those goals? Like, are they giving you regular updates on that? So I would I would have a conversation with them about this. Like, what's your value prop? What are you doing for me here? We did all this setup. And the thing is, the financial planning itself is not this one-time event, and we hand you a 3-ring binder or something online, and you take it and you go and you implement it. But there is a little bit of the "what would you say you do here?" Insert Office Space meme here, right? Like, what are you doing? And I think if they can't provide an acceptable answer, it's probably time to move on. If you don't have a complicated financial life in a situation, like, you don't necessarily need an advisor. Some people desire one in that scenario, but it's not for everyone. So it's not definitely not necessary if you don't need help in these ways.
Yeah, I'm curious, reading this question, what came to mind for me is, what would you say in your experience is the number one reason people fire a financial advisor?
I mean, the biggest one is just a lack of trust, or they're not helping you at all. They're not communicating. A big one it's interesting how often we hear someone coming to us from another financial advisor saying, they just never communicated with me. They didn't talk to me. They weren't transparent enough. And I think that's a big, obviously, like, people would think, well, it's performance. And obviously, if you have an advisor that puts you in a bunch of crappy stuff and they lose a bunch of money, that's an easy one. But a lot of times, people just want to know that they're going to be okay, that you're doing something for them. And a lot of it boils down to education and communication, and just being there and actually doing something. Right? Because a lot of times a lot of the movement for a financial plan is going on behind the scenes, but the client wants to know that you're there to help them and listen and help them make better decisions. And if you're not communicating with your clients, they don't feel like they're being heard or that you're doing anything for them.
We also see people in tricky situations a lot that write in and are like, I'm like friends with my advisor, or it's a family friend, and there's a lot of sticky, kind of weird situations that I think people find themselves in.
And the easiest rip the Band-Aid off for us that we've heard is, listen, my parents had their own person, their guy, and we have no ties to this person at all. We are ripping the Band-Aid off, and we are out of there. That we see what they're doing. They weren't doing the right job or whatever it is, and so those are easier. But yeah, it can be difficult because you do build a relationship here. But if they can't provide a value prop, then get out of there. It's time to move on.
Yeah, that makes sense.
Next question.
Oh, also, I was going to say, we take for granted sometimes we have such a good community that watches week in and week out. If you're new here and you see me looking around, it's because I'm looking at the live chat on YouTube. So if you're watching this on Twitter and you want to jump in the chat, that's on YouTube. So pull us up on YouTube and yeah, say hey in the chat. Yeah. All right. Up next, we have a question from Jeff. I've been reading Barry Ritholtz, that is, since his Washington Post days, and have always taken his message of don't mix politics with your portfolio to heart. It hasn't always been easy, but surely policies from a new administration have to matter, right? How do you square this line of thinking?
As usual on this show, ask by name and you shall receive. Let's bring him on.
Hey, Barry.
Hey, guys.
Barry, what was that? Early to mid 2010s you were writing for the Washington Post?
Yeah, for about 7 years, and legitimately the first column I did in 2011 was, hey, DC, here's the new gig, and I'm here to start by warning you, never mix your day job, never mix your politics with the markets. And you could, 2013, and you could see it in a number of studies where after an election, 08, Obama gets elected, Republicans move to cash, and they mix, they literally, Obama sworn in on January 20th, 60 days later, the market bottoms and it's off to the races.
One of the headlines was Obama's killing the Dow, right?
That was an op-ed the day before the bottom, to just give you a sense of how terrible the timing is. And so if you, and by the way, it works on both sides. When Trump got elected, a study found that in areas, so all this is anonymized, so they have to do it by zip code. And it was a major firm, and we don't know if it was Merrill Lynch or Schwab, but it's something like that. And when they looked at changes post-2016 election by zip code, areas that voted more heavily against Trump moved to cash, moved to bonds, and missed, the rest of the, ongoing rally, pandemic crash, and recovery. And it was just for no other reason than the guy you didn't like got elected. I don't know if you guys remember, Duncan, you aren't here, but Ben, you were here in 2016. So I did a letter to clients that I wrote the day before the election results were final, and I left the last paragraph blank until the morning, and I woke up and I said, hey, half of you are not going to be happy with the outcome of this election. The good news is you're going to have tax cuts and deficit spending. The bad news, some of your favorite, whatever it is, issues, charities, philanthropies are going to get cut. Take your tax cut and redeploy it towards the things you believe in, regardless of which side you're on, but leave your portfolio alone. The challenge today is, okay, what's going to happen? Is there going to be a war on companies? Is there going to be a big tax cut? Is there going to be tariffs? Is there going to be deficit spending? Half of that stuff is bad. Half of that stuff is good. Being able to figure out exactly how it impacts the markets is all but impossible. And remember, this was really detailed in Michael Lewis's book about SBF and Jane Street trading, that Jane Street figured out state by state the results of the election a few minutes ahead of CNN. And so they made a ton of money just anticipating the outcome of the election, and then they failed to make the pivot that, all right, Trump won, we're going to get tax cuts and deficit spending. That's, whether you dislike it for other reasons, ultimately that money flows to the stock market, and it was really good for the market.
And your point has always been that the markets in the economy are so much bigger. I read your original piece, I think, and it was like the U.S. economy is $17 trillion. Good luck moving that around on your own. Now it's
and that was
30
10 years
trillion.
ago. Now,
yeah,
right.
30 trillion. And I think the main point here is that, of course, policies will matter. They will matter to certain industries and sectors and individuals. Like we're not saying they won't matter. The question is, can you actually predict which ones will lead to different outcomes for different stocks or sectors or whatever it is? And the biggest one for me that I always point out is, like, people think, okay, Republicans are better for energy stocks, right?
I was about to say that same thing, yeah.
Energy stocks did horrible under Trump. They did great under Biden. And so that's the point, is that it's a lot of times it's counterintuitive to think what will, and we often overreact immediately, right? You see certain sectors going way up right now, we're going way down, and you go, okay, this is how the next 4 years is going to be. And markets aren't always right. Markets don't get it right. There's going to be some counterintuitive things that happen here. And the point is, it's very difficult to figure out what those are going to be.
Here's the thing that I think most lay people overlook, and traders and market professionals have a better sense of this. Hey, if we're talking about this, if this is on CNN or Fox News, if this is in the Wall Street Journal or the New York Times, it's pretty fair to say that it's already built into the price mostly. So you can't trade on widely understood public information because the market is mostly efficient. It's not perfectly efficient. But hey, the biggest risk is tariffs. Are we really going to have a 10% tariff? Is that, or a 60% tariff? Is that a negotiating position? What's really going to come out of this? We don't know. Are we really going to deport 10 million people? I mean, the prison population of the United States is 1.2 million people. Are we going to deport 10x the U.S. prison? What country is going to accept them? So all of these, like, major campaign planks and all these promises, I always take them with a big grain of salt. Everybody makes these promises. Most of them don't really come true.
Are you telling me politicians don't always follow through with their promises?
I'm still waiting for the wall to go up along the Mexican border. We built 5 miles, and it turned out Mexico didn't pay for it. So it doesn't matter what they say. What you have to look at what they're going to do. The fact that the Republicans have both houses of Congress makes me pretty confident that the 2017 Tax Cuts and Job Act will be renewed. Maybe even there'll be another $1 trillion or $2 trillion tax cut, and there'll be more deficit spending. Ultimately, that falls to it ends up goosing the stock market over the short term, and over the long term, the more tax cuts there are, the more people are going to spend. That ultimately ends up gets recycled in the economy. We can talk about the long-term impacts of that for 10, 20 years down the road of deficit spending, but that's not going to affect my portfolio.
It is kind of funny, though, that
years.
in 2016, the resounding theme from pundits was Trump is going to crash the markets, right? Because remember, the market was down 8% overnight, and this time around, there's going to be a boom. So it's just curious to see how that collective wisdom will bear out. I think the next question here is a good case in point of this entire theme. So Duncan, read the next question because this is a good add-on here.
Okay. Up next, we have a question from Owen. My wife and I plan on selling our house once my youngest graduates high school in 2.5 years. My wife is pushing for us to sell it in the spring of 2025 instead of waiting until spring of 2027 because she believes home prices will be down considerably in 2027 due to Trump's policies and inflation. I tried to channel my inner Ben and tell her that there's no way to predict these things, but she's pressing me hard. Any suggestions on how to address this situation?
I'm not sure how I feel about being used in marital disagreements, but this is the perfect follow-up to the last question. I guess my whole thinking is that like vibes for sure are not actionable when it comes to investments, and my other general rule of thumb, besides don't mix politics with your portfolio, is timing the housing market is very, very difficult. If you can afford to service the debt on a house, you should buy it, right? If that's what you want to do. If you need to sell a home, I don't think you try to time it perfectly based on mortgage rates and where you think prices are going to go. I got an email from a guy Michael and I did in like April 2021 saying, I live in Seattle. The housing prices here are going nuts. I feel like it's time to lock it in. And I looked back at that today, and I think housing prices in Seattle are up 30% since then or something. And so I think if you're thinking through this, the timing of the housing market, maybe to give your wife some credit here, her thinking doesn't make a lot of sense because if there is inflation, that's usually good for housing prices, right? Housing did really well in the 70s and early 80s. But it's possible that she's just stressed out about having this hang over her head for 2 or 3 years. And I think if that's the reason she wants to sell, that makes more sense to me than having some idea about what Trump's presidency is going to do to housing prices.
And here's the other thing about housing that's so important. When you look at the graph of new home construction going back to the mid-2000s, it ran up into the financial crisis, and then it plummeted for more than a decade. And depending on who you want to believe, the National Association of Realtors or the Home Builders Association, we're 2, 3, 4 million homes short, and it's going to take anywhere from 5 to 10 years to catch up with the population growth. And remember when everybody was living in their parents' basement, those people all moved out, and they're all doing well. And the reason prices have gone up so much is simply supply and demand. The demand dramatically exceeds the supply until that straightens out, which could take years. I'm not a seller of real estate on a speculative basis. And when you're doing it based on politics, it's an emotional decision. I'm curious what this guy's wife's track record forecasting movements in the housing market has been over the past few years.
And a house is already the most emotional asset there is because it's the roof over your head. So my wife and I actually did this. So we owned our home up north, and we decided to build a new one in a better spot. And there was going to be about a 12-month period between the time our house was done and when we listed it. But my wife just didn't want to have that hanging over us. Like the timing of selling this one and then buying this one. We didn't want to carry 2 houses. And at that point, mortgage rates had started moving up. This is back in the 3 or 4% mortgage days. They went from 4 to 5.
This is when houses cost $80,000, right?
Yeah, sure, in 2022. So we sold it a year early and missed out on a year in this house to wait for the other one to be done. But it was a huge peace of mind thing for us, and maybe we missed out on further price gains. But for us, it was fine because we knew that house was sold. We had the down payment ready for the new one. So if that's the idea for your wife, that she just wants peace of mind, that makes way more sense to me than I'm trying to time politics here and use that to gauge the housing market, which is a hyper-local thing. Sure, policies can impact housing prices on a national basis, but you're also talking about the local housing market and what that means for us. So I would never try to use politics to time the housing market from that perspective.
Agreed.
The thing I just can't get over looking at houses is I see houses that now seem like an okay deal by today's standards, and then I look at the price history and see that it's doubled in value over the last 3 years. I'm just like, I'm not doing that.
Don't look.
I'm not doing that. I can't do that. Yeah.
Duncan,
that's not a good deal.
You're going to be waiting forever if that's the case, probably.
Okay, I'll wait on a pullback.
All right. Next question.
Okay, up next, we have, my non-registered assets have been sitting in cash for about a year because I sold a lot of investments to purchase a home. I wanted a cushion for this home purchase, as well as funds for renovations, unknowns, etc. That's now complete, and I have a good chunk left over. Let's just say the amount is worth many Michael mudroom renovations and Audi SUVs. This person watches animal spirits. I've watched a run up in the market over the last year, and I know I should pull the trigger and lump sum the funds back into the market. But man, the euphoria just doesn't seem sustainable. So as a hedge to this, I was thinking the best way to force myself back in would be to automatically invest. I'm thinking this trickles the funds back in, and if there's a correction, I can dump more into the market. What are your thoughts?
I mean, this has to be the subject we've got more questions on than anything over the years, just the dollar cost averaging, lump sum kind of thing. Barry, do you think the equation changes at all in a bull market? Because I feel like it's way easier to dollar cost average in a bear market because you think to yourself, well, it'll keep going down and I'll just keep putting money in on a regular basis. I don't think either situation is easy, but do you think that the calculus changes at all during, like, the emotional aspect of it during a bull market?
So our colleague Nick Majuli actually ran the numbers on this and found 2 out of 3 times, if you look at all rolling periods going back to, I think it was 1950, the lump sum investing beats the dollar cost averaging because you get the benefit of compounding over time longer.
And the market usually goes up.
Right. The challenge is that most of us look at a rising market and say, I missed it, not recognizing that markets run further and last longer, bull markets, than most people realize. And so, if you're putting a chunk in, if you need it in 1, 2, 3 years, well, then maybe equities isn't where that money should be parked. I'm looking to buy a beach house. We're selling another one, and the money I have for the down payment is sitting in a 5% money market account. But if I didn't need that money for 10 years or longer, well, then just put the money to work and, recognize that most of the time the trend is your friend and the bull market will work in your advantage. There are times when it won't, but meanwhile, it's to try and time it. You could have said the same thing 95, 97, 98, 99. And then once you had the dot-com implosion, you could have just said the same thing. 09, 10, 11, 12, 13. It went on and on. It just is so challenging to try and forecast. It's all but impossible.
And you can't make it outcome based either. So I did this. I sold something in late 2022 and I had a big slug, and I thought, you know what? This is right around probably when the market bottomed. And I said, I'm just going to dollar cost average this over the next 12 months. I'm going to put an equal amount in every 2 weeks. And I followed that through for 12 months, and the market ran up in 2023, right? And it was going up and up, and felt like it went up the whole time. There was a few pullbacks, but I should have just lump summed in it. But I was actually okay with that decision I made at the time because that's what I decided to do at the time. It actually made it easier for me to put that money to work. So I think for most people, probably that dollar cost averaging from a psychological perspective makes more sense. I think you'll feel better about that decision regardless of what happens, just because it takes the burden of putting it all in at once and waiting for that shoe to drop.
2 out of 3 times it's the worst decision, but if emotionally you can't get past it, then DCA is your answer.
Right. This is our first not to brag of the day, too. He's sitting on a pile of cash. He's fine either way, right?
Yeah, sounding pretty good.
All right, we got one more question.
All right, last but not least, we have a pretty depressing question, but a good one nonetheless. This is from Josh. What would be your hedge if China invades Taiwan? Gold, commodities, Intel, Qualcomm, L3 Harris? Some very specific names in there.
Yeah, we're talking about the chips, obviously. I don't know, you short Taiwan semiconductor. This is another one that's often counterintuitive. What's the Art Cashin story, right? They're talking about the Cuban Missile Crisis, and it was like, look, kid, if you hear the missiles flying, you buy them. You don't sell them because if they shoot the missiles, it's not going to matter anyway. The trades won't clear, and if they don't, market's going to be fine. This is another tough one because let's say you knew ahead of time Russia is going to invade Ukraine, right? What would you have done? I'm going to buy oil. I'm going to buy commodities. I looked at this today. Oil was $87 a barrel coming into that when they announced Russia invaded Ukraine. It shot up to more than $100 immediately, I think, by the next month. And everyone was saying $200 oil is guaranteed. Here it comes. Today, oil is around $70 a barrel. It basically has been straight down since then, hasn't gone anywhere. So you could have known that conflict was coming, and you still probably wouldn't have profited from it at the time. So I kind of feel the same way about this. It's often counterintuitive outcomes, and it's not always going to work out like you think.
It's amazing. It's amazing how much we think we know what's going to happen. And, you know, Russia invading Ukraine is a perfect example. There was noise about it for 9 months. A lot of people didn't believe it. But as a little bit of a hedge, the price of oil crept up long before the invasion actually took place. And so it's buy the rumor, sell the news. And that's what's so counterintuitive for the layperson. Wait, this just happened. Why is oil going the wrong direction? Oh, you're 6 months late to this trade.
Yes, and every time that something flares up in the Middle East, so we've had a war essentially in the Middle East and in Ukraine with Russia, and the oil market has done nothing over the past 12 months, basically.
It's amazing.
Yes, so I don't think that you try to hedge these things. I used to listen to one of the macro places back in the 2010s in my endowment foundation days. And I remember they would come out with these reports and they would say, this tiny island in the Pacific sitting in between Japan and China, this is the most important piece of real estate on the planet because if China and Japan fight over it, then the world will come to an end. And so I think you get some of these people that are always predicting this stuff. And obviously we know conflicts can happen. They are happening now and they will happen, but I don't think it makes sense to put this into your plan of attack in any means. If you want to take some of your fund account and, I don't know, short NVIDIA or Taiwan Semiconductor or something like that, sure, have at it, but I don't think putting this into your investment plan makes any sense.
I totally agree.
I learned my lesson, Ben, when I bought that zero coupon bond ETF before the first cut, and it ended up just dropping like a stone over the next couple of weeks. So
Wasn't it down 8 days in a row or something? The Fed's going to cut rates and interest rates move higher. Funny how that works.
It was down more than like most of the stocks in my portfolio. So yeah, no thanks.
Yeah, I mean, this gets back to Barry's thing about headlines, right? Like, a lot of times the market has already moved by the time it reaches the headline. You can't look at the headline and then go, oh, okay, now I'm going to make this change. It doesn't necessarily work like that. Barry, you announced some details on your new book this week, right? I think we have Daniel show the picture here.
Yeah, that's right. Actually, that's the, that's it. That's the latest one. Comes out March 18th. I just announced on Monday that the final manuscript went in. You know what it's like writing a book, Ben. You've written more books than any of us in the firm practically combined. And so there's a little editing back and forth. It's funny, this differed from Bailout Nation in that it felt a little more luxurious and I wasn't under a time pressure that everything was happening in real time. Like every time a new company blew up, I had to go back and re-edit that chapter. Oh, wait, Bank America's buying Merrill. Let me rewrite that. This just felt like I had, maybe the luxury of time is the wrong word. This just felt like I could really put some time and effort into thinking it out. And it sounds weird, and this was joyous to write. This was fun. It was a little bit of a puzzle trying to put the pieces together, but I'm thrilled with how it came out. The initial feedback has been great. Super excited. You know, we've had a century of books telling people what to do, and most people are still bad investors. And so the concept was, hey, wouldn't it be great if we learned the things not to do? If we can listen to Charlie Munger, who said Berkshire was successful not because we were smarter than everybody else, we were just less stupid, which is a very Munger thing to say. You know, don't be smarter, just be less stupid. Or Charlie Ellis, who wrote the book Winning the Loser's Game, which is 99% of tennis players are amateurs, and they lose by unforced errors. You know, the pros make the aces. They hit the ball on the line. They place it perfectly. But amateurs mess up and lose themselves. The same is true for investing. If instead of trying to hit home runs, you just attempt to make fewer errors, you're way ahead of everybody else.
Jack White from the White Stripes called this the liberation of limiting yourself. And so he would limit the kind of instruments that they could do on albums to make it easier to write and produce the music. Same thing.
That's really interesting. You know, I love the fact, and this goes back to the original question about, do we sell our house? Do we get out of our stocks? Jack White said when I forgot which hit it was. Maybe it was, I don't remember the name of the hit with the great riff that starts Seven Nation.
Yeah, Seven Nation
Army.
Seven Nation Army. So The record company didn't like it. Nobody thought it was going to be a hit. That became an anthem worldwide that literally nobody in the industry had any idea was going to work out. And it's a perfect example of we think we know what's happening in the future, and really we have no idea. The first 20% of the book is showing all these examples of, from music, from film, from television, that the smartest, most experienced, best track record people in the industry, these Beatles, we don't think their sound is going to last. Star Wars, a Western in space, who wants to do that? Raiders of the Lost Ark, couldn't find a buyer. Literally, Keanu Reeves had to reach into his own pocket to finish filming John Wick because the studios thought it was junk and they didn't want anything to do with it. It's a $2 billion franchise. Nobody knows what's going to happen in the future. And if you think you could guess, hey, a president was just elected and he's coming in January 20th, this is what it means for our house in 2027? You're really delusional if you think that any human being has that ability. It just
Nobody
doesn't
knows
happen.
nothing, right?
Nobody knows
You can
anything,
pre-order the book
absolutely.
now.
Yeah, absolutely. Go to Amazon, go to Barnes & Noble, go to your favorite book buyer, or if you go to Ritholtz.com, you'll see the link right there. Click on
Right.
it.
Perfect. All right. Our email here. Oh, go ahead.
Sorry, before we go, Dave in the chat is asking about your electric Porsche. Barry, have you been driving lately?
I had it out this weekend. It was really a lovely day, and I thought let's take this out. I have come to the realization that a 1987 2,500-pound 300,000-mile car that has suddenly been upgraded to 400 horsepower, I think I need to put a whole new different set of brakes. I think I have to take like a 2005 set of brakes and backdate this because
Maybe put a harness in it too.
I mean, at least it has a 3-point, a regular seatbelt. Anytime I drive something from the 1960s, like the 60s era Corvette, it's a lap belt, and there isn't even a passenger side mirror. It's like, what were they thinking? Oh, and let's drop a 400 horsepower V8 into this thing with its
Barry, you
crappy
need some risk
brakes.
management.
I don't take those sort of cars out unless it's in very controlled conditions, but I very much recognize that, hey, there's not a lot of room for error with 400 horsepower and old. So I'm going to see if I can get these brakes upgraded. But meanwhile,
Barry's driving Duncan's 2 times levered NASDAQ fund out there.
The funny thing is every time
It's 3 times levered.
I pull up anywhere and the license plate is EV911, someone says, that's not really electric, so I have to pop the trunk and show them there's no engine there. It's just a big battery pack, and underneath it, a Tesla motor sitting right on top of the axle. And they're like, why would you do that to this car? I'm like, it's 300,000 miles. It was heading to the junkyard before I rescued it. So that's why. But
And
it's a lot
awesome.
of fun.
Yeah.
Yeah, it's a ton
Yeah.
of fun.
Cool.
So you get to reset the odometer then, right? When you put the new
I
battery in there?
guess. I mean, it's still, a 300,000 mile car. The difference is, so I replaced the original brakes. I cleaned up the steering column. I replaced all the light bulbs and the electrical wiring. So everything works. But, any car from the 80s, hey, it's 40 years old. These things were, not built to last this long. And so it creaks the suspension. I replaced the suspension, also kind of tightened it up to carry the extra weight of. So it went from 2,400 to about 2,800 pounds. So I upgraded the suspension to carry a little more weight, which really was shockingly inexpensive, unlike everything else on the car. But it's just a fun, people have a hard time wrapping their brain around it. I took a couple of friends out in it, including a guy who is a Porsche dealer / collector, and he's like, I just can't wrap my head around this. This old car is going way too fast for what it is. It doesn't make any sense.
We need to get out there and do some footage of you in this.
I'd love to. That would be a blast. It's a ton of fun.
You need some driving gloves. All right. askthecompoundshow@gmail.com is our email. Like, rate, review. Masters in Business with Barry. check out the big picture, all that good stuff. See you next time.
Thanks, everyone.